Currency correlations are one of the most powerful yet often neglected techniques when it comes to trading forex. It is especially important for traders who trade more than one currency pair, as it can significantly boost profitability and reduce market risk. Forex correlation may sound complicated, but in this video I hope to simplify it, allowing you to incorporate it in your daily trading routine. What is currency correlation? A currency correlation in Forex is a positive or negative relationship between two separate currency pairs. A positive correlation means that the two currency pairs will move in the same direction, and a negative correlation means that they move in opposite directions. Correlations can help you maximize your profits, but they can also be used to hedge your Forex positions and exposure to risk. We cover this in a video of ours called How to Hedge a Forex Trade. Let's understand how currency correlations work. Well, you can have a perfect correlation, which means that there's a correlation coefficient of +1. This means two currency pairs will always move in the same direction and to the same extent. So if one goes up by 100 pips, the other pair would go up by 100 pips. Similarly, if there's perfect negative correlation of -1, this would indicate that two currency pairs will always move in opposite directions and to the same extent. So if one pair rises by 100 pips, the other pair will fall by 100 pips, and vice versa. If you open a long position on two currency pairs which are strongly positively correlated with a correlation coefficient of between 0.5 and 1, you're basically increasing your risk, as both pairs will likely move in the same direction most of the time. One of those basic correlation types that you must understand is between currencies. Two individual currencies can exhibit a certain correlation due to their specific fundamental characteristics. Risky currencies such as the Australian dollar, New Zealand dollar, and to a lesser extent the euro tend to fall simultaneously in times of global economic and political turmoil. As you can see here, this is the chart for the Australian dollar to the US dollar. And in 2009, after the global financial crash, it dropped very, very quickly. But also with risky currencies is that when market participants show an increased appetite for risk, like after this event, these currencies tend to increase in value very quickly, as you can see here. And so this characteristic makes them positively correlated with each other. So the Australian dollar is positively correlated with the New Zealand dollar and with the euro. The opposite of risky currencies are safe haven currencies, such as the Japanese yen, the Swiss franc, and to a lesser extent the US dollar. These currencies tend to rise in times of economic and political uncertainty, which is why they're called safe havens. So looking at this chart, this is the chart for the euro to the Japanese yen. As you can see, in 2008-2009, during the height of the market crash, you can see that the Japanese yen rose in value very, very quickly. Safe haven currencies are mostly positively correlated between each other, meaning the Japanese yen and the Swiss franc are positively correlated, and so is the US dollar. Safe haven currencies are inversely or negatively correlated to risky currencies. Usually, when the dollar moves up, gold falls. This is because during times of economic unrest, investors tend to dump the dollar in favor of gold. Also, you should know that Australia is the third biggest gold producer, and so gold has a positive correlation with the Australian dollar to the US dollar. As you can see on this chart, the line chart represents gold, and the Japanese candlesticks represent the Australian dollar to the US dollar. As you can see, when the Australian dollar moves up, gold also moves up, and vice versa. When it falls down, they both fall down. When one goes up, the other also goes up. The Swiss franc also is positively correlated with gold, but for a different reason than the Australian dollar. The Swiss franc is positively correlated with gold because more than 25% of Switzerland's money is backed by gold reserves. Gold has a negative correlation with the US dollar to the Swiss franc. When gold goes up, the US dollar to the Swiss franc goes down, and when gold goes down, the US dollar to the Swiss franc goes up. As you can see on this chart, when gold goes up, the US dollar to the Swiss franc goes down, and when the US dollar to the Swiss franc goes up, gold comes down. The final type of intermarket correlation we'll be looking at is the one between the Canadian dollar and oil. The price of the Canadian dollar is often positively correlated with the price of oil. An increase in the price of oil will see an increase in the value of the Canadian dollar on the forex market. And so this is often reflected in movements in the US dollar to Canadian dollar pair, because oil is traded in the US dollar, and the US dollar is generally negatively correlated with the price of oil. And what this means is that when the US dollar increases, the price of oil tends to decrease. It also means that an increase in the price of oil will usually mean a decrease in the value of the dollar. So you can use this information to take long positions on the Canadian dollar, such as in the Canadian dollar to the Swiss franc pair when oil is rising, or take a short position on the US dollar, such as in the US dollar to Canadian dollar pair when oil is rising again. This is because Canada is one of the top oil producers in the world, and it exports over 3 million barrels of oil per day to the United States. And because of the volume involved, it creates a huge amount of demand for Canadian dollars. You should also know that Canada's economy is dependent on exports, with about 85% of its exports going to the United States. Because of this, the US dollar to Canadian dollar pair can be greatly affected by how US consumers react to changes in oil prices. If the US demand rises, manufacturers will need to order more oil to keep up with demand, and this can lead to a rise in oil prices, which might lead to a fall in the US dollar to Canadian dollar. If the US demand falls, manufacturers may decide to order less oil, and so demand for oil might fall, which could hurt demand for the Canadian dollar. So, as I said, when oil goes up, the US dollar to Canadian dollar goes down, and when oil goes up, the US dollar to Canadian dollar goes up. So, let's look at this chart here. The line chart represents the price of oil, and the Japanese candlesticks represents the pair, the Canadian dollar to the Swiss franc. As you can see, as oil increases, the Canadian dollar gets stronger, and it usually mirrors oil quite almost perfectly. It goes up together, then it comes down together, and it carries on like this all the way up. What you see here is the Forex pairs correlation table, also called a Forex matrix, with the numbers inside being the Pearson correlation coefficient, the most used measure of currency correlations in the Forex market. It's important to look up these correlation tables regularly because the correlations can change over time. So, the most highly correlated currency pairs are usually those with close economic ties. Let's look at the euro to the USD and the pound to the USD. They are often positively correlated because of the close relationship between the euro and a pound. This is because of their close geographic proximity and their status as the two of the world's most widely held reserve currencies. Also, pairs that include the same currency as either the base or counter currency tend to have stronger correlations. This is obvious because the same fundamentals impact those pairs. Let's look at the euro to the Swiss franc and the euro to the US dollar. As you can see here, they have a very strong positive correlation of 0.9131. And if you look at the Japanese pound to Japanese yen to the euro to pound, you will see that they have a very strong negative correlation of minus 0.8544. Now let's look at an example of when they have the same counter currency with the Australian dollar to the US dollar and the euro to the US dollar. As you can see that they again have a very strong positive correlation of 0.91. When trading using currency correlations, the best opportunities to profit arise when two inversely correlated pairs both show a buy or sell signal, or when two strongly positively correlated pairs show opposite signals, one being long and the other one short, as in these cases you can exploit it and reduce your market risk, because if one signal doesn't go in your favor, the other one likely will. Traders will typically take positions on correlated pairs in order to diversify themselves while maintaining the same overall direction, either up or down. This could be to protect themselves from the risk of a single pair moving against them, as they will still have the opportunity to profit on the other pair if that happens. Thank you for watching. I hope you enjoyed the video. Please do like and subscribe. Today is your opportunity to build the tomorrow you want.